CoreLogic drops their US home price insights for May. Lagging data, but it's a month forward from the Case-Shiller index that I shared with you 2 weeks ago. They report gains on gains on gains, and that's great for homeowners. What about buyers wanting to come into the market? Well, we have some good news. I'll walk you through what CoreLogic is reporting for the market, as well as the San Diego figure they spotlighted. June CPI report, the report that Wall Street watches the closest, was released and it's not what we expected. I'll share with you what's ahead based on what this CPI report had and what impact it'll have on the possibility of the Fed's cutting rates this year. And if you didn't see it, the market was really reactive after the data dropped. So stay tuned. A consumer sentiment report on the real estate market was recently released. Consumers are changing their tune. Well, what does this mean for the real estate market? Well, you gotta stay tuned for that. This is only the hook. All this covered here in this week's San Diego Market Matters. I'm Karl, your San Diego realtor. Let's jump into it. Real quick, if you find these videos of me nerding out about the real estate market valuable, or if you don't and you just feel really bad for me, consider subscribing to the channel and liking this video to support my business. It's 100% free, meaning it doesn't cost you a penny. And as a thank you, here's a super cute pic of my pups. And real quick, if you're thinking of selling or buying here in San Diego, there's a link in the description below where you can schedule a meeting with me so we can discuss your goals and how I can help you achieve them. But if that seems a little annoying, you can always call me directly. Now, on to the good stuff. CoreLogic releases their May report on home prices. What they post is a 4.9% year-over-year gain nationally and a 0.06% month-over-month. If you recall 2 weeks ago in my San Diego Market Matters, Case-Shiller, the gold standard of real estate market reports of this nature, reported a 6.3% year-over-year gain in April. CoreLogic's report at 4.9% supports the idea that Case-Shiller will probably report a gain in the 5% range for May when that finally comes out. So what is this all telling us? It's saying that price appreciation is inching down. It's not dropping off a cliff, it's not plummeting, it's not nosediving, it's not flushing down the toilet. It's cooling off, it's slowing down. It's approaching a more reasonable and manageable appreciation level that coincides with income gains over time. The May report makes for the 148th consecutive month of annual growth in the United States. That takes us all the way back to 2012. So for those of you that have been expecting a market crash since 2016 and still are, I'd love to hear more about what makes you think we will suddenly, finally experience a crash.
Well, interest rates are high and so are values.
Yeah, and they have been for the last 2 years, but that didn't stop buyers from buying nevertheless. Prior to that, when rates were low, people were complaining that prices were too high, and yet homes were still selling and prices were still going up. I'm not suggesting that this will go on forever, but look at the data and the market. Price appreciation is slowly coming down, but we don't know when it will tip. What happens if price continues to trickle down? The Feds then adjust rates, which I'll talk about shortly, and the prices will stabilize and then start to slowly grow again. Future pace here with me. We know what the market did over the last 148 months. What will it look like 148 months forward? Do you think prices will be lower or higher than they are today? Elevated mortgage rates have definitely slowed down sales and price growth. That's what they were supposed to do. So if rates are cut in the next 12 to 24 months, what will likely happen to demand then? Now, if you look at this map that CoreLogic did where they isolated growth to particular cities, you'll see San Diego at a 9.2% growth year over year. With the gradual descent of year-over-year price gains, it will be a little while before we get close to the zero gain or even a negative gain year over year. Enough of that, let's go ahead and move on to the next topic. The Consumer Price Index, aka CPI, the primary metric that Wall Street and the news follows, was released Thursday morning with really good news. It ended up being better than expected. May was a flat month with no gain, and if we could have gotten that again, that would have been awesome. The original forecast for CPI was to rise 0.1% in June after having a flat month in May. As for core CPI, which is CPI minus food and energy due to their volatility, that was expected to rise 0.2%. Both really minimal increases. That's not what happened though. CPI reported a negative 0.1% and core CPI came in at 0.1%, both below expectations. As a result, the market celebrated and mortgage interest rates dropped below 7%. Anyone that locked up a property over the weekend likely scored on rate on Monday. Now, let's get a little more context on what this means and why it's such a big deal. In addition, I'm gonna share with you some bad news. First off, the Federal Reserve, led by Jerome Powell, has a dual mandate from the government to get inflation down to 2% and to maximize employment. Head Chair Jerome Powell has expressed over and over that the current Fed funds rate is high enough and that we only need time for it to make its impact and bring inflation down. Well, folks, he was right. He was spot freaking on. And as you can see on this graph, the blue line represents CPI and the pinkish line represents core CPI. Remember, core CPI doesn't include food and energy because their values bounce around so much, and you can see that in the blue line. Regardless, both are trending downwards. CPI, the blue line, has been consistent for the last 4 readings, while core CPI has been consistently trending downwards since this time last year. So Jerome Powell was right. This puts CPI at 3%, which is the lowest it's been in 3 years. All the while, core CPI is sitting at 3.3%, and that's the lowest it's been since April of 2021. Crazy, right? Now, here's what we need next. The 3% range has been labeled as sticky. Since getting into the 3% range back in June of 2023, we have yet to get below it. Now, as I mentioned earlier, Jerome Powell is confident that the market only needs time for the elevated rates to settle in and gradually bring inflation down to the 2% range. But as much as these recent readings for CPI were big wins, we need to see this again on August 14th when the next CPI readings come out for July. If by some chance the downward trend does not sustain, one of two things is very likely to happen. Number one, rates will be held for the remainder of the year. Or number two, the feds will have to seriously consider raising the Fed funds rate because where it's at now isn't enough to get us down to 2%. If that happens, mortgage rates will likely rise. So now here's the bad news. The market is betting in a 95% chance that the feds will do a rate cut in September. Remember, Jerome Powell has to lower inflation to 2% and maximize employment. Well, the national unemployment rate came in at 4.1%, which is the highest it's been since 2021. And at the same time, 206,000 jobs were added in the month of June. In addition, wage growth, though it's coming down, is still outpacing inflation. Bottom line, the labor market is barely starting to soften. With that being said, this is what I think. There's a really good chance that rates will hold for the remainder of the year, with a high chance of them having to be raised before cutting them. Now, to end this on a good note, though a rate cut may not be likely this year, next year it's extremely possible to start seeing the Fed bring the elevated rates down. At the recent European Central Bank Forum, Jerome Powell stated that they don't expect us to hit 2% inflation until 2026. At the earliest, the end of 2025 if we're lucky. So as we continue to show positive progress in bringing down inflation, all we gotta do is hold out for the labor market to cool off, and then the feds can make their adjustments. Now on to the last topic for this week. Fannie Mae, one of the larger government loan providers, does a monthly consumer sentiment survey. In this survey, they ask 6 questions. Number 1, buying conditions. 2, selling conditions. 3, home price outlook. 4, mortgage rate outlook. 5, job loss concern. And 6, change in household income. The goal of the survey is to understand consumer attitudes, intention, and perception of the housing market. This gives us insight as to how confident consumers are in the market and in what the government is doing to steer the market in the right direction. Something to keep in mind, this home purchase sentiment index came out prior to the CPI report I just told you about. So let's jump into this. For June, 19% of consumers indicated it's a good time to buy, and this is up 4% from last month, May, which was at an all-time low. For some reason, some consumers are finding more confidence in the real estate market going ahead. At the same time, 81% believe it's a bad time to buy, but the majority of consumers have been thinking it's a bad time to buy for the last 4 years, even when prices were lower and rates were lower. Interestingly, even before COVID, I would hear people regularly talk about how prices were too high and not affordable. Now that the recent CPI report came out with really good numbers. It'll be interesting to see what the consumer sentiment does around buying next month. Not only does the majority of consumers believe it's a good time to sell, the majority also thinks prices will continue to go up over the next 12 months. This is very, very reasonable to think. Labor market is strong, rate cuts are becoming more and more realistic next year as inflation is getting under better control with every month that passes. Lastly, and this is really important to look at, almost 80% of consumers are not concerned with job loss, and at the same time, 16% showed that their income was significantly higher than this time last year. Okay, so how does this factor in? Think of labor market strength and affordability. The market shift is more likely to be influenced by affordability versus some random catastrophe that will flood the market with inventory. With job stability sentiment very high, consumers will be confident to buy. At the same time, if income isn't significantly growing for a majority of households, price growth in housing will be limited to income growth and the smaller pool of consumers that have experienced significant income growth. If this pool keeps getting chiseled down, then we will have less qualified buyers at higher price points, thus less demand and possible price correction. And that's a wrap for this week's San Diego Market Matters video. If you found this information valuable, be sure to hit the like button and subscribe to my channel for the weekly updates on the San Diego real estate market. And if you're considering on buying or selling here in San Diego, don't hesitate to reach out to me for the expert guidance that you need specifically tailored to your needs. As always, I'm Karl, your San Diego realtor. I'll see you in the next video.